Hello, everybody. Welcome to Monday Morning Must Knows. My name is Merlin Rothfeld, and here are several things to pay attention to for the upcoming trading week. Now, as a review, last week we saw some tremendous market volatility. A lot of political statements being made, and of course, interest rate discussions, which caused that extreme volatility. And really, I don't expect that to change at all going forward. Now, this week we have some huge market potential movers, and I'm going to start things off with the calm stuff. We'll start with earnings. There's only 175 companies reporting this week. Last week there was 166. It's fairly quiet, but there are some big names which may impact your portfolio. On Monday, you've got Nike reporting earnings. Tuesday is a big goose egg, and then on Wednesday, you have General Mills, McCormick and Company, and Paychecks. Now, moving further into the week, you've got Micron on Thursday, as long as Constellation Brands and Walgreens Boots Alliance. And that is your entire earnings week. So very, very boring. Now, the next stuff is very interesting, especially when you take a step back and we look at the United States of America. Many say the greatest country on earth. It's the reserve currency of the world. It's America. Well, we're starting to show some chinks in that armor, and it's not really looking great with regards to GDP and economic growth. Now, we'll look at GDP this week because about 3 weeks ago, you have preliminary GDP, and then you have, I think, advanced GDP. There's these two readings of GDP, then you get your final, and then you get your revised. So we already kind of know what the GDP number is going to be, and that's most likely going to be a negative number. Now, why is this interesting? It's very interesting because on Wednesday, we get that final GDP number. That's going to be at 8:30 a.m. Eastern Standard Time. And as you can see on this chart, going back into 2020, and GDP was doing great. You had 4%, 6%. The previous reading there was like 6.9%. Everyone's like, yes, America, they're beautiful. And then Q1 of 2022, negative 1.5. I was like, gulp, oh boy, that doesn't look very good. Well, as we know, one of the basic ways that people measure a recession is they'll say 2 consecutive quarters of negative GDP growth. And as you saw on that chart, Q1 was negative. Okay, well, maybe Q2 will come out positive. Well, remember, there's 4 readings of GDP. You have the preliminary, you have the advanced, you have the final, and then you have the revised. Well, the advanced and the preliminary all tell you what the final GDP number is going to be, and they've both read negative. So what that means is we've known for 3 weeks that we're most likely going to have a negative 1.4% contraction in Q2 GDP for the United States, which means 2 consecutive quarters of negative GDP growth, which means what? Recession! Here we go, recession! And what's funny about that is Jerome Powell, chairman of the Fed, has been saying for months, no recession, no recession, no recession, just rinse and repeat over and over again. And last week, he says, there's a slight chance that we could see a recession. Really? Thank you, Dr. Obvious, because I'm saying recession, recession, recession. And what we'll see this week is the media will start to blast the headlines with recession talk. Now, this should spread more fear into the financial markets, which might not be a good thing for the overall equity indexes. Of course, for those of us who are active traders and understand supply and demand and trends, it could present us with some great opportunities. But there's a bigger picture and much more longer lasting thing that's going to come from this. Let's take a look at the debt to the GDP ratio. This means the amount of total government debt in conjunction with GDP or related to GDP. And you notice going back into the 1970s, we were down around, 30 to 1. Well, now we're at about 125 to 1. You can see that it's just surging on the right-hand side of that chart. Right now, approaching 140. Now, why is this important? I want you to think of a couple different countries. Think of Venezuela. I want you to think of Sudan. I want you to think of Libya. I want you to think of Lebanon. Now, these may be great countries, but as far as economic stability and being a financial powerhouse, none of those should ring a bell to go, man, Libya is just killing it in the financial markets. What an economic powerhouse Sudan is. Well, if we continue on with this increase of debt to GDP ratio, guess who we're competing with? We're right around the same debt to GDP ratio as Lebanon, Libya, Sudan, and maybe we can reach the apex of that pyramid and we'll be up there with Venezuela. Now, is that going to happen? Well, look, debt to GDP, that's the ratio. What we're seeing is GDP decline. So if GDP declines and debt stays exactly where it's at, what's going to happen to that number? It's going to continue to move up because the debt is increasing and GDP is dropping. But what we're seeing right now is not only a lack of decline of debt, we're seeing an astronomical increase in debt, not only in the federal level, but the highest levels of consumer credit consumption that we've ever seen. So be careful here going forward. This paints a very negative picture for the U.S. economy in the long term. Of course, it could change, and we'll keep track of that on Monday Morning Must Knows. Now, the last piece here, we're going to wrap things up with another piece of economic data, and it goes back to inflation. Right, a couple weeks ago, before the Fed made their announcement of 75 basis point increase, it was supposed to be 50. They said no chance we're going to do 75. And really what happened was CPI, an inflationary number, came out, and that number was very negative. Jerome Powell said, we're raising 75 basis points. But the Fed has also said CPI is not the most important one. It's the core PCE Price Index. And as you can see on this chart, we've seen elevated levels over the past few quarters. Right now, the expectation is that we're going to come out right where we were before, right around that 0.3%. So any change from that, any deviation from that expectation could create more waves. And if it comes above 0.3%, then what that does is it makes us think that the July meeting of the Federal Reserve could see much higher rates going forward. Again, could be 50 basis points, maybe 75 or even higher than that. That, my friends, is your Monday Morning Must Knows. We'll see you next week.